Welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer of First Source Investment Advisors. Joining me today is Eric Clapsaddle. He's our Senior Fixed Income Portfolio Manager. For the past 100 years, First Source has been partnering with our clients and assisting them through a variety of investment markets, including the Great Depression, Great Recession, the tech bubble, a housing bubble, and obviously numerous bull markets. And today we're actually helping them navigate what is currently the longest economic expansion in U.S. history. What's made this expansion a bit unique is the amount of intervention by both the Federal Reserve and central banks across the world. And in fact, across the world, there's been a situation where interest rates are actually negative. And so a lot of our clients are asking us, what do negative interest rates mean and how do they actually work? So Eric, could you tell our clients a little bit about how negative interest rates actually work?
Yeah, absolutely. So it's strange that you even have to ask such a question, but the way negative interest rates work would be one buys a bond and pays a premium on that, and then the total income they receive from that bond until it matures is less than the premium they paid. For instance, if you paid $1,050 for a bond, that'd be a $50 premium. The total income you receive before it matures will be less than that $50 that you paid a premium for.
So essentially, you're guaranteeing yourself a loss.
Essentially, yeah.
So why would a central bank set up a structure where an investor is going to guarantee a loss?
Sure. So central banks around the world, Japan, Switzerland, European Central Bank, have implemented this policy to force banking institutions, lending institutions to lend money as opposed to holding on deposit, force consumers to either spend their money or, unfortunately, even against their will, buy riskier assets. And beyond that, cheapen their exports by reducing the strength of their currency.
So obviously, we have central banks trying that across the world. The United States still has positive interest rates, as we know, much lower than they were about a year ago. So do we see negative interest rates coming to the United States?
To put U.S. rates into perspective a little bit, though rates have significantly fallen in the U.S., been cut in half almost since October, November of last year, we don't see negative rates coming to the U.S. It's not worked in other places around the world. We see it being detrimental to banking institutions, really the cornerstone of any developed economy. We see it being a negative for savers, and we save money in this country. And we also see it being a negative effect for the overall U.S. economy. For those reasons alone, and there's many more beyond that, we see the illogical policy of negative rates not coming to the United States.
Well, Eric, thanks for sharing on how negative interest rates work, why central banks are using them, and our thoughts on interest rates in the United States. Regardless of what's happening in the markets, just like we have for over 100 years, First Source is always going to provide you straight talk, sound advice, keeping your best interest in mind for the long term.